Are you thinking about renting your house or your condo to a family member and giving them a deal on the rent? Well, this is an area where you really need to be careful. One wrong move can turn your rental into a personal residence for tax purposes, which would kill your losses, limit your deductions, and create gift tax issues for you. Today, I'll show you the traps and the exact steps that you need to do to stay compliant and avoid those issues. My name is Merrill Taylor. I own a CPA firm where we help real estate investors and high earners avoid expensive mistakes. This video is educational in purpose and is not individual advice, so make sure you talk to your CPA about your specific facts and any risks that may be specific to you. Now, to get into this, the IRS treats renting to relatives differently than renting to, say, like a third party. So if you do not charge a fair market rent and operate at what's called an arm's length distance, the IRS can reclassify the property as a personal use asset. And that often means that you cannot take any losses, passive or ordinary. You can't take deductions from it against other income. Deductions are limited to the rental income that comes in, and you could potentially only property taxes and mortgage interest could be your only deductions as an itemized deduction on Schedule A if you itemize at all. That's what happens if the IRS comes in and deems like this isn't really a rental property, this is really just a second home, then everything goes as an itemized deduction on Schedule A if you can even itemize. So you may lose all benefits altogether if that happens. So here we have pitfall number one, if you charge below market. So if you charge your relative less than the fair market rent, the days that they occupy generally count as personal use rather than as rental use. And that can flip you into a vacation home or a personal residence rules where rental expenses are limited and losses are disallowed. So to avoid this, you want to price at fair market value rent and be ready to prove that rent with listings, comparables, a broker opinion, or prior arm's length rentals. You want to use a written lease with normal clauses like due dates, late fees, and deposits, and enforce the payment based on those due dates. Skipping rent looks like gifting and not an arm's length arrangement, so you want to avoid any skipping of rent or giving them a free month or something along those lines. Pitfall number two is calling it a rental when it's really their own personal residence. Rather than a second residence, maybe it's their home instead. So if your relative uses the place as their principal residence and pays full fair market value rent under a real lease, the IRS will generally respect it as a rental. But the second you discount the rent, forgive months, or include excessive personal perks, you risk conveying it to the personal use for you, killing losses and depreciation benefits. Pitfall number three comes with the vacation home rules. So even if you charge a fair market rent, your own personal use can trip you up. If personal use, including family use, at less than fair market rent exceeds the greater of 14 days or 10% of the rental days, you're under the vacation home limit rules, and you must allocate expenses between personal and rental days, and losses are limited or eliminated altogether. Family use counts as personal unless they pay fair market rent and treat it like a real rental. Pitfall number four in this area is no paper trail. So a text message lease or cash payments and no late fees are audit red flags. You want to treat family like any other tenant. You want to get a signed lease and a security deposit, charge a market rate late fees if they pay rent late, collect bank transfer, collect that rent by bank transfer or by check. You want to keep mileage logs for landlord trips and save receipts for repairs and supplies. Pitfall number five is what's called gifting by accident. So if fair market rent is, say, $2,500 and you charge, say, $1,000, there's a $1,500 difference between those two. That difference can be viewed as a gift to your family member. And that may be fine, but be aware of the annual gift tax exclusion and that you may need to file a gift tax return if you exceed that exclusion amount. Gifts don't create deductions for you. That's a very common misconception. People think if they give somebody money that it's some kind of a deduction. It's actually the opposite. Whenever you give somebody money, you could actually be the paid tax on that as the giftor of that money. Pitfall number six is repair versus improvements. So renting to family can blur lines. Repairs keep the property in working condition and are generally deductible, subject to rental rules. Improvements add value or extend life and usually must be capitalized and depreciated. Sloppy categorization invites adjustments in an audit. If you called something a repair that was really an improvement, that could become an issue. Pitfall number 7 in our list is passive loss rules still apply. Rental real estate is typically passive. Losses usually can't offset wages or business income unless you qualify for the $25,000 active participation allowance, which phases out with higher income, or you qualify as a real estate professional and materially participate in that rental activity, or you have passive income from other sources to absorb the passive losses that are coming through. Renting to relatives doesn't unlock special loss treatment on its own, so be aware of that. All right, pitfall number 8, we got 2 more here. Depreciation and recapture. If it's a valid rental, you must depreciate the building. When you sell the property, the IRS will capture that depreciation as ordinary income up to the allowed or allowable amount of depreciation that was taken or should have been taken. So you do not want to skip depreciation just because it's family. Skipping today doesn't avoid recapture later. It only loses your deductions now. It's that IRS rule of allowed or allowable. Basically, it just means like the IRS is going to say that you took depreciation or count you taking depreciation whether you take it or not. And when you sell that property, even if you didn't take depreciation, the IRS is going to treat you like you did and tax you on taking depreciation. So might as well take the depreciation because you're going to be taxed on it one way or another. Pitfall number 9 is the local landlord laws that you want to look out for. If it's family or not, you're still a landlord. Many cities require rental licenses, habitability standards, and specific security deposit rules. Non-compliance can void parts of your lease or trigger penalties. Another way the arrangement can look non-arm's length, so just be careful with that. So here's how to do it right. You want to prove fair market value rent with comparables. Look around and see what other similar properties are renting for and rent for a similar, and document that. Like if you find a listing for a rental online, make sure you print that out, show the date, and you'll want to update that regularly. A broker letter could also help, or prior listings if you've rented that in the past. But again, you're going to want to update that because rent changes from year to year and time to time, sometimes month to month. You want to use a real lease with market terms, deposits, and late fees and have that signed. Just like you would rent to anyone else, follow the exact same rules, exact same things that you would do. You want to collect and enforce rent. You don't want any skipped months or any side deals going on. Document everything with bank payments, maintenance logs, receipts, and mileage. Keep a separate bank account for the rental. Track personal versus rental days to avoid vacation home limits. And then plan the tax. Know if losses will be suspended and model depreciation and recapture. If you truly want to subsidize housing, consider gifting cash separately while still charging fair market rent. It creates a clean paper trail and cleaner taxes that way. All right, let's look at quick case studies just to kind of put it all together. So let's say case A, we have mates rates condo. So you charge your college-age nephew half rent. The result is below fair market rent, and it's treated as personal use. Expenses are limited and losses are disallowed, and the discount may be a gift each month. The fix for this is to charge fair market rent and gift separately if you want to help. All right, so case B is parents, their additional dwelling unit at fair market rent. So let's say you sign a standard lease, collect a deposit, charge fair market rent, enforce late fees, and you do zero personal use. Result, it counts as a rental. Normal depreciation expense rules still apply, and you're still subject to passive loss limits. All right, case C, you have a lake house with family holidays. You rent at fair market rent most of the year, but host family for free 2 weeks every summer. Those 2 weeks are considered personal use. If personal days exceed 14 days or 10% of rental days, then you trigger vacation home limits. And the fix for that is watch the day counts or block those dates for paying guests instead. All right, some quick FAQs just to kind of wrap this all up. So if pay utilities but a lower rent, is that fair market value rent? Well, you need to look at the total package, rent plus utilities, and compare to the market and document it. Can you forgive a month of rent at Christmas, let's say? Well, that looks like a gift and a below fair market month, and it undermines the arm length behavior, so be careful of that. What if they fall behind? Then you're going to want to enforce your lease like you would with any other tenant. Non-enforcement is evidence of personal use. Do I have to issue a 1099 to my relative? Tenants do not get a 1099, but if you pay contractors $600 or more for work, you may need to issue a 1099 where required for them. All right, so before you rent a family, price it at fair market value rent, put a real estate lease in place, and decide up front if you're subsidizing, and if so, gift separately. And if this video is helpful for you, make sure to hit the like and subscribe button, share this with someone who may be considering a family rental, and we'll make sure to bring you all the tax updates as they come.